So in this session, we're going to cover the following topics. But before we go on to what we're going to actually cover, let's just remind you that this presentation is provided for general information. In fact, I will leave you to read this. Okay, I assume you've read this, and I'm assuming you can hear me okay as well. I can see a couple of you texting there. So, okay, let's just move on. So what I'm actually going to cover then is how the right mindset can help have an effect on your trading, a possible one, marvelous. How the US election could impact the markets, and how to trade during a period of high market volatility. So that's what we're going to be covering tonight. So I'm going to get straight into it. Actually, just before I do so, I should really introduce myself. If you haven't seen or met me before, my name is Kym Watson. I'm a full-time trader and also co-founder of Easy Trader. We started back in the early 2000s, but I was actually trading well before then, trading stocks, options. Got a bit fancier on the futures and different option plays, etc. Eventually ended up trading Forex, and I've been trading Forex, goodness, from about 2003 or 4 full time. Actually, I just trade Forex these days. So predominantly a day trader, although I do roll into some swing trades as well and position trades, so longer term position trades, but predominantly more of a short term trader. So with Easy Trader, we operate sort of effectively two sides of it. We've got the swing trading side, and then we've got a day trading side. So the two merge nicely, but we have a specific day trading room where most days, well, every day, 5 days a week, we have it open, and we operate, we show our charts, and we will call some trades that we're taking live, and people can follow along or just watch and see how we manage our trades. So let's talk about trading and trading mindset. It's a very key part to trading. I've got some things here just to run through with you, which a lot of people believe are extremely important, like such as having a great strategy is seen as being very important. In fact, for a lot of people, the most important thing about trading. High win rates. Every time I ever speak to people and ask them, traders, what they really want to achieve, and they want something that gives them a really good high win rate, and it's absolutely essential, I'm told all the time, to make money in this market, in these markets. And for day traders, I'm a day trader, and it's well claimed that you should be sitting in front of your screen from about 6 o'clock in the morning till goodness knows when, 4 p.m. maybe, when the London market closes. But to be successful at it, you need to be sitting at your desk there. So that's what a lot of people are telling me, and I hear a lot. And if I was to tell you you could have a strategy with 30% win rate, people will probably look at me quite strangely and think, they ain't gonna work. So this is people's trading mindset. Effectively, this is what they want. They want high probability trades. They want, as I say, the best strategy they can possibly get. And if they're day trading, they think they've got to be sitting there to be really, really successful. However, strategies, reality. In reality, good strategies are only a very small part of being successful, and I say a very small part of being successful. You can have the best strategies ever, but unless you can trade those strategies, you really will struggle to do well. The thing with a good strategy, even if I gave you a good strategy, we don't get this linear win, loss, win, 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 loss, win basis. You could have 3 or 4, something that's a 70 or 80% win rate could still have about 6 or 7 losers in a row. It's just the way it is. If you've got a big enough sample, you can have a significant amount of losers amongst it, and they can run in one after the other consecutively, and that really throws traders off. So even though it's a really successful trade strategy, a good strategy, however you measure good or brilliant strategy, that is, a few losers in a row will throw a lot of traders off. Now, we see this day in, day out. We've got quite a few traders that come and join us in our trading room. If you give 20 different traders the same, I'm right, okay, I'm going short now. I'm going to take this position. I'm going to be shorting whatever it is, X, Y, Z, and I'm taking it at this price. Okay, you may get a few that are straight in there and they've got the right price, and I say the right price, a price that is similar to me if they're following, and they'll get that price. But I can guarantee you at different parts of that trade as it's rolling, different people would do different things to get different results. It's just, as I say, coming back to mindset. Different people will see the market differently. If I bring a chart up, I can't bring a chart up, I won't bring a chart up for a moment, but if I was to bring a chart up and you was to look at a chart and if the price action was moving upwards and you were long, for example, and then all of a sudden it sort of starts cutting back a little bit, and then a little bit more, and almost back to where you've entered. At this stage, traders will often close the position out. And particularly if it's open, pushed up, let's say it's pushed up 30 pips or so, and then it's pulled back 35 pips, so you're moving into that negative territory, they'll close the position out. That trade could go then run on and make 40 or 50 points positive, but those people are no longer in the trade. There's all sorts of feelings once they're not in the trade anymore, or they've cut it too short. Now there'll be always some that's cut it just as it made its first sort of 20 or 30 pip move, and they've got out and they're thinking, yes, when you're about 5 pips down on the trade, and they'll be looking at it and thinking, that was did so well then. But then, of course, when it goes back up again and breaks through that sort of that level and hits the sort of final target, then they just sort of thinking, well, they've been cheated. So this is this whole mindset that sort of creeps into different parts of the trading. As I said, if any day of the week, I can call a trade out. And as I said, I'll guarantee there's very few people that will get similar, let alone the same as me. It's very unlikely to get the same, even though we discuss this every day in the trading room, of course. Why is it? Well, as I said, numerous reasons why, what causes it. But it's purely mindset. There's fear, there's greed. You'll see this coming time and time again in terms of trading, and you'll hear me saying fear, greed. They're sitting there watching it. Okay, win rates. You've got to have high win rates. Win rates are not that important, believe it or not. It's not that important to have a high win rate. I'm not going to show you it tonight, but there's an account, one of our traders. She was a trader that we actually suggested she stopped trading, ironically, a long time ago. And I could still say that again because she did particularly well. She went through a fantastic phase, but she only had about a 35% win rate. I've got the account somewhere, but she had about a 35% win rate. And I can't remember what she had. I think she had like a 50,000 account originally, and she took it up to about 200,000. But she was just leaving the winners to roll and roll and roll and adding into some of those winners, and she was doing pretty well. Now, it proved that she wasn't particularly good at choosing her trades necessarily, but once she got into a trade that was winning, she could hang in there, and that was the important thing for her. Unfortunately, later on, she started giving it back, but or some of it back. But either way, it just proved that, if you got it right and you've got those trades that are running, win rates aren't that important. It really depends on the returns. And this is the biggest thing that a lot of traders miss out on, is they get so set in their mind in terms of win rates and high win rates, high percentage, high probability trades, that they forget they're there to make money. Now, I don't trade to be right, I trade to make money, and that's the important thing as a professional trader, is to be making money out of what you're doing. It doesn't matter, and effectively, if I have 3 or 4 losses in a row, I just think, well, they're the losses out of the way, and perhaps the next one may be a winner. So that's how I look at trading. I'm not really too fast if I've got a row of losses. And it goes like that sometimes. These markets over the last couple of days, they've not been the most straightforward to measure, to trade, and to get a winner in them, and to get a winner that runs, well, there's nothing really running, so it'd be a difficult one at the moment, but we'll see. But the important thing here is the returns, your returns on what you're doing. Now, I've put a chart on my screen here. And I'm just, if I run across the top there, if we look at a percentage, the percentage win rate, you know, if you've got a 70% win rate, I've put on the top here, that 70% win rate on a 2-to-1 win rate, if you're winning risk reward, this is. So if you're getting 2 reward for every 1 you risk, so if I put, say, £1,000 down and I make £2,000, that's effectively a 2-to-1. What I mean by a 2-to-1. But if you're looking at the actual win rates here, you can see the only time you're really out of the money and you're negative is if you're sitting there with 20 or 30% win rates with a 2-to-1, or 3-to-1 or 4-to-1 with 20% win rates. You need to be, if you're running at 5-to-1, you can be a pretty bad picker as long as you allow your winners to run. And this is again getting back to mindset, because a lot of people, they get so set in terms of the position and they're profitable, they close it quickly. And if I've looked at a lot of broker stats in the past, and that I've been fortunate to see, and people are pretty good at choosing and they can have a reasonable higher win rate, but they can still lose money, because the problem is their losers lose them more than their winners, because psychologically it's in their mindset to think that you're not going to win money, or say win or earn money is probably the better word. You're not going to earn money unless you've got a high probability of winning. You're winning regularly, which is complete nonsense, because you, as I said, it's showing you here, you can still be winning a 20% win rate so long as your winners are running 5 times as much as your losers. And so a lot of professional traders are running around about the 55 sort of percent. If you can run through spells, running at a 60%, maybe if you're lucky, you run into a 70% run. But overall, if you net that out, you'll find that often 40 to 50 even percent win rate. So the win rates aren't the be all and end all. The thing that you've got to be making sure is you're on each trade, and you're doing this on a regular basis, is when you set up your trade and looking at your strategy, you've got the ability to make more than the risk that you're putting up there. Now, that doesn't mean to say you use very small stops and then just to take a normal exit. So for example, put a 5 pip stop on a 20 pip move and say, well, I've got a nice 4-to-1 there, because at the end of the day, the market's going to just knock you out. I mean, if Trump sneezes, it'll take your trade straight out of there, won't it? So you've got to be looking at where you're placing your stops and placing your stops wisely. But the focus has to be on placing the stops wisely and ensuring when you're setting out to take the trade that there's the belief that and from a technical basis, the reward you're looking at is possible. If you're looking at something which is a price level that's not been hit ever, or is not been hit for 2 years, and it's not even moving towards it at the moment, don't look for the impossible. Look at where things are and they're possible. Look at the average true range of that market and ensure that there's a possibility of it going to where you think it's going to go to, maybe a previous high or something like this. And if you're looking at that and taking that as your target, well, that's okay, it's achievable. It's been there before recently. It may be getting back to there again. Now, is that target and that risk that you're taking correct? Now, I could go into a whole session on risk reward and looking at it, and I'm so tempted to, but I don't want to take away the focus of what we're really looking at here is mindset, because the mindset is all sitting there about win rates. You've got to have high win rates. It's not true. You can have 40%, 50% win rates and still make good money. The important thing is not to be focused, as I say, just on those small wins, just grabbing. And going back to when I've analyzed some broker data, is when the average win, and I don't know if you do this analysis yourself, but if you look at your results, the average win was like like about 10 pips or something like this. The average loss was 100 pips, because traders don't like losing, because they think if I'm losing, if I'm taking a loss here, it's wrong. So again, it's a mindset thing. Now, it's a fear of losing. Is that you actually, a lot of them are losing a lot of money because they don't like losing. Weird, isn't it? Weirdly as it is. Okay, trade watching. Sitting with watching your open trade, I can tell you this, and even after years of trading, and the worst thing sometimes is, as with our day trading room, I'm sitting there looking at and calling trades, and I'm actually seeing the charts all of the day. I've got to sit, because I'm talking to people, and okay, well, I'll take a break from about 10 o'clock through to 11:30, so it gets me away from those doldrums when the markets can go barely anywhere. So, but I'm sitting there and I'm talking through the charts. I'm doing technical analysis, and all of a sudden you might sort of go down onto charts, or I'm looking up here. I've got charts all over the screens up here, but you're sitting there and you're watching the charts moving all the time, and it's probably one of the worst things you can do, because as a technical analyst, I can sit there and I can see a raise and hold on that 5-minute time frame. Let's just put a lower high in, and you can all of a sudden see reasons why people don't succeed in terms of they'll come out early. The market's going to go. It is never a straight line. It's always going to be up. Oh, I would say never. Sometimes it goes up pretty quickly and pretty sharpish, and you get into a good move. But for a lot of the time, it's moving up and down. It may go quite against you for a bit, and then move up. That's just the waves in the market, that they're there. Sitting watching them is, as I say, seriously detrimental to your account, because at those traders I was talking about earlier on, where you're up on the trade and you're actually doing pretty well, and then it comes back and you're going negative, who are closing off their positions. Then, if they weren't sitting there watching it, they wouldn't be closing off the positions until it hit their stop. The reason we place stops is to get stopped. You don't need to sit there and watch yourself get stopped or close it off any earlier. The reason you placed the stop in the first place was because you thought that was a good place to be, away from current price action, which if it moves against me a bit, I've still got a chance of staying in this trade if in the way the markets move. So the important thing is if you're sitting in front of your screen, you're more likely, if you're looking at that and looking at what you're trading. What I do is, if I call a trade, I've got 8 screens in front of me sitting here. 4 of them have got charts on. I won't be looking at what I'm trading. Normally I get reminded in the trading room, oh, the euro's moving, it's nearly at the target, which I then tell people off, because they're actually looking, and as soon as someone says the target is nearly hitting the target, I can assure you price turns round. It's an absolute, almost definite in our trading room. Anyone says it's nearing the target, you only ever say the price has hit the target, never say it's getting near it, because otherwise it doesn't. It's just the way it goes. So, but the important thing is, don't be there screen watching of what you're in. Look at what you might want to be in. So look, if you're going to be sitting there, and I do sit here, even on a day like this. I wasn't in a day trading room today. My business partner was in the trading room, and so he was trading. I was sitting here. I was doing some other things. I was preparing the slides for this evening, and I wasn't really looking at the charts. I was in position. Position works or it doesn't work. I mean, one of the positions I was in was from yesterday. That got stopped out eventually this morning. I got another position later on that's taken profit on that. That's it. I don't need to sit there and watch it and watch it and watch it. So, as I say, watching your trading can be detrimental. And the thing is, it gets back to emotions and trader mindset. And this is, as I say, the importance of this first part of this session. But there's some good news here, because it's not going to last. I'm not going to go on for all through this webinar on this subject, because there's some good news that you can actually watch the content of what I'm talking about in a lot more detail. Charlie Burton, my trading business partner, co-founder Easy Trader, has recorded 2 sessions on it, and it's gone through it in a lot of detail. And you'll hear him say lots of the same things. We see the same things day in, day out in a trading room with people, and it gives us a great insight to the mentality of people, different people. And we've got on there he's got so many different things I'll come on to in a moment. But screen watching, as I said, coming back to my slide here, it stirs those emotions: fear, greed, the two emotions. They're okay to have both. It's okay to have these, but just control them. Okay. So let's talk about free education. Now, XTB have commissioned us to produce these videos, so you can actually go and watch them. Now, you can't currently go and watch them. You need to have a trading account, a funded trading account, a live trading account, but you will be able to go onto that trading account. Let me just, I will bring it up. I'll show you the area. It's going to be up in the next couple of days or so. If I can find the area, where are we? Now, I'm going to change charts. You're not seeing that at the moment. Let me just change screen sharing. So stop sharing that one. And then start sharing this here. Nope, wrong one. There we go, there. Share that. Okay, so you can see, hopefully. No, you can't see, hopefully, at all. You're seeing me. I didn't press the share button. Let's try again. Okay. Now you should be seeing me. Okay, so you just will be clicking onto this within XStation. You'll be clicking, you've got the different levels across here, and there's an education section here, and you'll find it down here when it's actually posted. But I just want to show you where it is. So when you open XStation, there's the charts, etc. But there's actually a section across here called education. You just pop on that, and you'll find the sections on there. Okay, I showed you that. It's very briefly. I just wanted to show you exactly where it was. Let me just switch back now and put back what I want to just run back onto. Screen 4. Hopefully that's going to show you the right thing. Share that one. So as a client of XTB, and as I say, you've got to have a funded account to do so. If you've already got a funded account, that's fine. You'll be able to go and see those in the next day or so. But if you want to see these two sessions that Charlie's recorded on Traders Mindset, you just need to go onto the trading video section there, and you will find them. Now, within them, I did actually just cut and paste what he'd covered in these. This is just it's a study of the various problems traders have had: banking profits too soon, over leveraged, over trading, moving stops too soon, a whole lot here. He's given some case studies of real people. He's kindly named the name changed, but I've changed the names. Now, it's all right showing someone a problem, and you probably, if you're sitting here, you may well be aware that, oh yeah, I do that. I tend to see it coming against me and decide to close out, and then off it goes and wins. I do all these things. And it's actually, on these two sessions that are recorded there, it's actually got some solutions to those problems. So you can go and watch those. As I say, you'll find some solutions and some real practical guidance, really good guidance in terms of what works. And what he personally, I personally, this is, I grabbed this off his slide screen actually, what he personally does in any of these situations. So there's different things that works for us. And it really is a case of, we've got here the last thing there, you create a skin like a rhino. That's what again about win rates and things like this. People, if they have a loss, they almost take it personally. And I asking our training room, how's it going, guys? Or how did it go yesterday, or whatever, and they'll say, oh, it's just horrible. I had 2 losses. But you can gather, even when they're just typing, you just gather the things. Oh my goodness, what's happened? Is your world ended? The thing is, if you understand that you can still win money with a lowish or modest win rate, but so long as you're using, as I say, the bigger rewards than losses in the first place, and you stick to them, and if you get stopped out because it came in with a 5 pips or 4 pips or even a pip within your target, yet it turned around and you lost. The thing is, it's just another trade, and that's how you got to look at every trade that you take. It's just another trade. If it's a winner and it wins, it's just another trade, because sure as eggs are eggs, you're gonna have a loser soon. Even if you get into a good run, I had a fantastic run through September. Was one of my best months for a long time, and it was just ticking along, and every day it was just sort of ticking along, and you just think, well, that loser's just around the corner, isn't it? And you may be a little bit more picky with some of the trades that you take. I mean, even now as a full-time trader, I sometimes sit there thinking, am I reducing the? I mean, I'm not a big over trader anyway. A lot of people, I mean, one of the things on this slide here is about over trading. A lot of people believe as a day trader you need to take 3 or 4 or 5 trades a day. Sometimes if I've got a good trade and it's one trade, I'll just take the one trade. That's fine. It's all about what you're doing. I mean, if you're trading and you've just made 1% on your account on a trade, or maybe even 2%, you've risked 1%. Let's say you've made 2% on that money. 2% on your account is is a reasonable amount, but people, for some reasons, and partly the reasons are those people out there that are telling you this time next year, Rodney, you'll be a millionaire with your $10,000 account, which you're going to make $1 million. And they'll be driving around in their flash cars and everything else on their videos on all these things. We see them all the time, but it's not like that. Reality is, if you were to put money into an account, and at the end of the year you had 40% or 30% up, surely you'd be quite chuffed with that. But I don't know. It's just, as I say, the mindsets. And anyway, these 2 videos, they go over the mindset situation, and hopefully will help you become a better trader, or whichever way. Or if you're struggling, make you turn that corner. Sometimes you just think, I just needed that. It's just someone may have said at some stage. It just is that it's the catalyst to change things. Okay, so enough on that. As I say, there's 2 videos there. It's there. You need to be a XTB client. If you're a client with funded account, you can go into the area. Demo accounts don't work, fellas and ladies. You've got to have a funded account. You do that and you're in. Right, moving on then. I was asked this question. I keep getting asked this question, and it's a sort of, my answer is quite simple. How long is a piece of string? Because how are the US elections? How can they impact the markets? Reality is, most people don't know. There's all this guessing, and I'm really wary of making guesses. But there are certain things, as I said here, one thing I'm certain of, there's a lot of uncertainty regarding US elections. Last time we were expecting Clinton to win. I said they were. You start thinking, well, actually we can't really believe anyone these days. And you're right, you can't, because everyone has their agenda out there. News services may be run by certain people that don't like certain people, and that you'll get a real biased view of things. You've got, of course, these Facebook and everything else, and maybe the Russians are joining in and destroying things, but good chance they're not. It may be that just people. Crikey, we have conversations in our trading room. One thing I always allow is discussions on politics. I find it really interesting, and it's nice to hear other people's views. So if it's a quiet day and we get running through some doldrums, we'll end up in politics. But it's so easy to hear other people's views, and there's a lot of different views. So with these elections, the views come through, they're fed through, and then you've got the banks, they've got their self-interest in what they're doing. So I'm always a bit wary of when Goldman Sachs or someone comes out with a bit of a statement of, you can read too much. The problem with reading too much and doing too much here is that you get an inner bias. You start becoming a little bit biased about where the markets may go, and the emphasis should be might or may, because we don't know where they're going to go. there's often in normal circumstances you'll see a market sort of moving, and it's some news has come out or whatever it may be, and it may be negative for the US, yet all of a sudden you're seeing the dollar go up anyway. It may be positive for the US and the dollar's going up. It may be negative, the dollar's going up. It's just the way the markets work. I mean, in terms of quite often, I think we may see a lot of days like today. We've seen today very tight ranges. I think leading up more and more towards those elections with the uncertainty out there and the gossip, and we're going to get sharp moves. If you look at the last week's pound was a classic one with Brexit. We had the Brexit conversation going on there, and the week before particularly, and there was sort of periods where if you look at a 4-hour chart, it's a whipsawing up and down movement, up and down, and we've got a very good chance, I think, technically, of seeing something like that. This situation where you've got the double bias towards the US dollar, it might come into play. Now, I say might because, well, in some respects, Trump said something the other day, and the dollar, he was going to not agree to sign the fiscal package. The stocks fell, the dollar flew up. The dollar flew up, and you think, hang on, where's the dollar flying? Well, it's a safety element. So the dollar becomes a run to safety. So risk is off, and the money goes into the dollar and generally the yen. Although it didn't quite go the same way the other day, and it's this real uncertainty. The thing with the markets in this day and age, and I've noticed it, and now I've been through some markets, I can tell you, is that things have changed, and I'm going to come on to trading volatility in a moment. But I've been through some real weird old markets, and the markets today tend to soften things a lot more than they used to. But one thing you can get is a trend start, and you can watch for that trend, and that's the way to be looking at things. Carrying on with this, the impact on the markets is already being seen at times. We're catching that at the moment. The impact, as I said, with the volatility. What happens? If whoever gets voted in, there's pros on both. I mean, Trump last time was a surprise that everyone expected everything to fall off the cliff, but with tax cuts, corporation tax cuts, and everything else, he was seen as a savior of the equity markets. Reality is, with those equity markets, whatever he did, the big money, the pension funds, when we got zero interest rates, they've got nowhere else to make money. And there's almost this move of the big money has had to go somewhere, and the big money is continually going towards equities because, well, you're not going to make a lot of money in terms of bonds or anything like this at the moment. So the safe areas where they would normally go is not really there to make the money that's needed to pay the pension. So big money is moving and has moved into equities regardless almost of what, or in spite of, maybe helped by, but equities have pushed up on the basis of where the big money is really running things. Yes, they probably feel safe there at times, but and they've continued to go into equities. So I think whoever wins, that you may get a similar sort of reaction. It may be a case of buy on the rumor, sell on the news. When markets may roll if Joe gets in, may roll if Trump gets in. It's second guessing, and all we can do is sit there and look at the technicals. We know that the important thing is to understand the dates and the times when the key news is due to be out. And I would strongly recommend, if you're a trader, swing trader or any other trader, don't ignore. That's telling you to ignore it, of course. Make sure you know what the news is. Make sure you understand exactly who's speaking when's the next conference on. And I heard in the car earlier on that Trump is now saying he doesn't want to do it via Zoom or whatever it may be. He doesn't want to do it remotely. He will only do another head-to-head if they're live. So you can really not understand Joe or you can understand Joe not really wanting to be in the same room as him at the moment, perhaps. Anyway, there we are. So be aware of who's saying what, not who's saying what, when people are supposed to be speaking. Ignore the noise, look at the charts, trade at the right times. So there are so many variables which makes determining any sort of possible outcome impossible, and all these sort of market knowledgeable people in the markets, they're just guessing at the end of the day, they're just doing best scenarios. I see some great best scenarios out there, and there's some people I'll listen to a little bit and think, yeah, I like that. They'll put it all together in a box, and here's a scenario of this happens, this is the likely outcome. Quite good, but they're not, when they're doing that, they're not actually suggesting that any one thing is going to happen. And I think if you just keep a very open mind, let the market and the news and the elections be, as we move closer and closer, there's the potential for huge volatility at times, and then periods of the doldrums where it's barely moving as traders get a little bit fearful and don't do anything. So it moves me on to how do we trade through this, and I've sort of hinted at periods of it. How do you trade through high market volatility? Now, people have their own opinions on this, and everyone has a belly button as well, don't they? So you know, I'll talk about my opinion and based on the volatility that I've seen. Now, I've seen a bit of volatility, such as the 1999/2000.com bubble. That's when I started really trading. It's just before then I was really trading, used to trade US shares and sell covered options on there. So I do covered calls, and it was leaning into it. It was quite nice. 7% on a individual stock, not on your whole account, but 7% on was a regular return on something like this. So over a month, and you think, well, this is great. And then of course the .com sort of came into play. I really messed things in some respects, but then I realized, well, actually I can buy different options and make money just by just trading the options, and it just changed. But it was a volatile old time. In those days, when I remember when you had the plunge protection team coming into play on the S&Ps, US markets, they'd have a shut off, and the market would be closed at certain points if it moves so many pips. I can't remember. I think it still works today, like in the same manner. But there's a safety button basically. But then what happened? There was a bunch of banks that would be all of a sudden buying, and they were effectively given a nod to buy, and they would be buying at the same time. And all of a sudden, so you'd be down 400 points in a session, in one day trading session, and then bang, it's gone up 500 points. So the markets were really quite vicious there. So I've gone through that, and of course we had the 2008. 7, 8, 9 crisis, and that sort of stuck with quite a while. I remember having to reset some of my indicators because they were given too many false positives effectively. I had to readjust the indicator to make it more useful. So we had those two, as I say, things changed. 2020, before this, we got into this elections, we had the period in March when COVID was and it's sort of, I say peak, I don't know how to put that. It's probably not been a peak at all, but at the previous peak, and how the markets reacted immediately to that. So we've seen the volatility there. It was a shorter spell and a different spell. And as I say, the markets have dulled down to where they used to be. You would sometimes, in the past, you would get something going and it would sell, and the market would sell for a week in big numbers. We don't see that very much now. The market will shrug things off. Some of the bad data that's come out of late, and the market, okay, it was an expectation, but it wasn't really all priced in there. You could argue it wasn't priced in there. People just thought, well, that's what it's going to be. That's what it's going to be. So volatility, it's to some respect, is sort of dulled down a little bit. However, the switchbacks are still there, so you've got to be very careful. Most important thing I would say trading volatility is manage your risk. So if you're risking 1% of your position, that a lot of traders do, they use 1% or 0.5% of their account to trade and build if they're trying to build their accounts, even if it's 0.25%, whatever percentage you're using of your account, keep it steady, making sure that you've got, in terms of the risk rewards, right. I've pointed out this before, in terms of more important than win rate is risk rewards, making sure you've got those winners to run for you, and they have an opportunity to run. So manage your risk, watch how much you're trading on each particular position, make sure that it's not going to give you a situation with margin calls. Be careful. Don't, it may be that you lighten up. I would be lightening up. So this is how I would be thinking things. I'm looking at, say, well, I may just take I can take a half a position effectively a bit more frequently if that sort of thing's happening. I've done it recently. I've been trading Forex on Monday. I just went in with half size. I said, look, this is I'm going to go in half size here because of the risk to this trade. So yeah, that's what we did. Okay. An important thing is to ensure that you don't feel like you have to trade. A full-time trader, and there's days I don't take trades. Last Friday I was waiting for non-farm payroll, so in the morning it was sort of I was sitting there. In the afternoon I was still sitting there, and after the news came out I was still sitting there. There was nothing to do. I mean, the market just didn't do anything, so I just stayed in cash. It's a good position. I didn't lose any money, so to me that's okay. I'm in a neutral position, and it's all about understanding through these periods that you can sit there in cash, watching a market. There'll be this back to this mindset thing that you feel like I'm missing out on something if you see it suddenly fly up. But just think about it the other way. I always turn this on the head and think, well, okay, the market's just flown up. What happens if I've been short on that? So there's always two sides to everything. Yeah, okay, did it really give you a signal? And it's no point looking at what could have, would have, should have. It's looking at how you do things and programming it. And this is so important, particularly through a period that we're probably going to go into. So it's going to be about doldrums and then sharp movements, then probably back into doldrums. That's how I think we'll see things anyway. And that's my view on it. Now, throughout this position sizing, as I say, really important, make sure that you're position sizing correctly, so you're not risking huge amounts of your account. The biggest way, as I said, I speak to brokers all of the time. My own account manager rings me up, and we've known each other for some time, and we'll have a chit chat, and I'm always asking questions about, am I the best? No. I'm asking questions about how's things going, and what do you see? How do you see this going? I mean, why are people failing? Because if we could literally put our finger and say, okay, if we could stop this and everyone could make money, well, realistically, it ain't going to happen, because the mindsets and people won't follow anything and do that anyway. But if you could get people to understand these situations, as I say, mindset's important. But where are people going wrong? And when I'm asking where people going wrong, putting too much money into a single trade. Now, no broker, and I'm sure XTB, who have asked me to come along this evening, will agree with me here, is no broker wants their clients to disappear because they've run out of money, because they've lost their money. They want them to continue trading and if they're successful and they continue trading, that's fine. Just keep it going. Just keep it going, because you're paying your broker the spread. They get the swaps. If you're doing overnight, they're getting income. If you lose all your money very quickly, that's the income. That's it. It's one shot. You've gone. And some people top up and then go. It's no good to them. So, as I say, what the key thing is speaking is that position sizing, oversized positions, the amount of oversized positions. Of course, I've already knocked on the other thing in terms of they'll hold on to their losers longer than they'll hold on to their winners. Be patient with your winners and less patient with your losers. Just stick with your original stops and just let it ride out. That's it. But the position sizing through volatility is important. Watch the average true range. It's quite interesting lately. I was every morning, you can find it on our Easy Trader YouTube site. I do a morning outlook. I just have a quick flick through, and it's 5-10 minutes. When I'm going through the markets there, I'm looking, and quite often I'm looking at scaling down the right-hand side and thinking, crikey, it's only 2 pips. And yes, squeeze the chart up and there's barely any movement some days. Other days I'm looking across there and it's like 10 pips or 15 pip sort of increments. So just be aware of what's going on. Look at what the market's done through the Asian session. If you're trading the Asian session, do the session before. Just look at what those sessions are doing and ensure that you're aware of if you're applying a stop, and this is the important thing, and why I'm saying this is if the market's been running with an average true range, for example, on the euro, it's around about 80 pips a day or something like that, I believe. I could look, but I'm being lazy now. But 80 or 90 pips, which is quite good. If it's running at that and you're swing trading, you've really got to consider where you're putting your stops, because if the average true range is 80 pips and you're going to put your stop 10 pips away from a low, chances are you're not really swing trading at all. You're sort of trying to day trade with a sort of swing trade mentality of where you think it might go, but you've got to give it space. Day trading wise, this is just as important. I look every morning at looking at the ranges and just checking, well, how much has it moved, and is that big enough compared to the average true range? On a day trading point of view, I'm normally looking at sort of 1.5, at least 2, let's say at least 1.5, normally 2 times that average true range. If I don't need to, I may tighten it up a little bit, but I can always tighten it up once it's moving a little bit. You can move stops, but not too aggressively, but you can move them. So it's just a case of, particularly when it's volatile, don't use a smallest position size. That's what I say, you should be calculating your position size based on the stop that you're using, so you can measure your amount at risk. If you're doing that, it's going to give a better opportunity and of staying in trade if it gets a bit snappy, and if it wins, that's great. But let's say, watch that average true range. Timing. How do we trade volatility? Sometimes, and I was waiting on non-farm payrolls, I wasn't trying to jump on board if anything happened fancy on, just press the button when you see it moving. I used to have a method of doing something before the news even came out, but it doesn't work this day and age. Brokers don't like it, to be fair, and it's hard for them to cover the position sometimes. So I find that mainly if you're trading news, do it post news. You've got time to wait. So you've got time to wait for the market to show you the way. Jesse Livermore was Confessions of a Stock Trader. If you've ever read the book, it's well worth reading. He talks about how when he very first started, he was a very successful trader at one stage. I think he did lose it all at one stage later because he struggled with his mindset. He jumped out the window, I think, in the end, or shot himself. He did something, came to a gruesome end. Anyway, but when his confessions of his trading periods and whatever else, when he was first trading, it was bucket shops and all sorts of weird and strange places, and it was ticker tape, and it was old fashioned. I mean, we're so lucky in terms of the modern technology that's now currently available to us, but he realized that he was trying to catch those absolute bottoms, absolute tops, literally to the cent sort of thing. And of course, yeah, he was very successful at times, and he was pretty good at reading the price action and just seeing when it was slowing up, and he could see this. But realistically, he was getting such delayed data coming down the telegraph, but it was quite low. In the end, he realized that he wasn't actually making much money. He was going through a lot of stress. And on some of these trades that would then stop him out quite quickly. So he ended up with a lot of stress and not a lot of reward for all that stress. Then he realized that if he cut the top and he cut the bottom off of the market and he made the chunk in between, he was always going to be much more successful. And that's what we do as traders, and that's what I'm looking for as a trader. Don't need to be in at that very first time it touches a moving average or something, unless that's a retracement. I'm thinking, well, even then I'll wait for a little bit of a reversal bar in a short time frame. So I'm looking down the time frames and waiting for that setup. So just when the news is coming out, give it a bit of time and see what's happening. Friday's non-farm payrolls was a classic. Okay, the upcoming presidential elections may be something completely different, but that non-farm payrolls, immediately the euro flicked up a little bit. It flicked up 10 or so. It wasn't very much, but it pipped up first, and then, oh, hang on a minute, and then gradually it just came down slowly, and it wasn't very much of a move at all. But it's just allowing the noise to get out of the way. As I said earlier on, there's a lot of people buy on the rumor and sell on the news. It's a common quote that's out there. You'll see that the big money's already done things, already changed things. So you just need to be aware of let that sort of, if you've got a bit more, if the news is coming out, all of a sudden there's a few buyers coming in, you don't need to join them suddenly straight away. You can wait a little bit and let what's happening, and maybe buy on a retrace, and that retrace may turn into a full retrace because it may be the selling on the news effect. So just be a bit patient with something like the presidential election. I think we'll probably be able to trade it the next day, the day after, and maybe a few days later. There may be that sort of time that'll be slow enough, and gradually you can jump into things. Sitting there trying to catch it, we might have a little go at it, but realistically, I think the best moves are going to be after the event. So there we are. That's timing. What have we got in hedging? Now, some people, there will, and certainly I can see by the amount of futures contracts opened by the commitment of traders reports, the big fund managers, I assume at the moment some of them are hedging. There's big positions going in there, big euro positions sitting there. I would imagine there's quite a lot of traders hedging into and getting into hedges now rather than when the news actually comes out, just hedging their overall positions. And us as individual traders, and personally, I'd rather be in cash than trying to mess around with hedges. I think people get too involved with trying to be too clever, and it becomes over sophisticated. Trading should be relatively easy. Once you've sorted your brain out, the trading itself is the easy bit, and it's a case of just ensuring that, you know, if you've got a long-term position that's sitting there, it may be you think, well, actually, I will just hedge it. But you're just making a neutral trade of any potential gain. There's either you leave it alone, or you can hedge it, but I think it can be over sophisticated. Sometimes it may be the signs in there that the market's weakening, but you think, well, hang on a minute, it's still got some potential if we're on the bigger term frames. But if you think it's that weak, why not just, okay, I can always go back into it. I can always trade it again. I can always go long on it again or short on it again. It really doesn't matter. So hedging is a possibility, but just be aware that be wary of over complicating your trading. Okay, that's pretty much it for me in terms of trading mindset. As I said, you can pick the videos up. They're quite long, the videos. Quite a bit of video to watch. There's actually 4 videos in the series. There's also building strategies, ironically, how to build them, looking at building strategies, and also trading commodities, and how to look at the sort of bigger picture. So they're all there. Say you do have to, if you're already a member of XTB, that's fine. You can watch that. Rest of the time, just be careful what you're doing. If you, that's my my feeling. I'm going to be very careful. I'm quite conservative, risk averse in some respects. I love a gamble, but there's a poker table to gamble on. On the markets, I'm taking a more refined gamble in terms of I've got more chance of measuring in, and I certainly won't be going all in one way or the other. That's for sure. So watch out for the volatility. It's going to be there. Which way these markets are going to go, whatever Trump or Biden, whoever gets there, Biden, whichever one wins, so much of a muchness. One thing I would say, in olden days, and this doesn't really count for much now, first year after a president gets in, generally the markets used to dump and everything used to get quite weak on the basis of that first year of a presidential cycle was the year that they could do all the things they needed to do, which they could blame the last president for. So you'd get the oh, we've got to pay back some of this debt. Well, the Americans are trillions of dollars in debt, and they're only going to ever increase. So long as they hold the reserve currency, that's the job of holding a reserve currency. do you really think we were really too sad when the pound was no longer the reserve currency? Whoever holds it holds the debt. Good luck for them on that one. Anyway, there we are. I've spoken enough now. It's 5 minutes away from the hour. I'll take any questions if there's any questions there. Of course, this is recorded onto XTB's YouTube site. So if you want to go through it, if you came in a bit late, there's plenty to watch there. Any questions, just fire away. Okay, if there's nothing, I'm going to call it an evening. I can smell dinner. I know there's a delay on the system, but there's nothing there at the moment. So I'm going to suggest we call it an evening. If you've got questions and you really want to ask anything, you can contact me personally. You can call Kym at easytrader.com. There you go. So you can contact me if you want to contact me. As I said, if you want to watch video updates in the morning, just go to our YouTube site, it's easytrader.com or easytrader YouTube, and you'll find us on there as well. Oh, okay, some questions now. Where can you watch the videos? Sorry, I did show it a little while ago, but if you go onto your XStation platform, third one in, I think it is. Let me just check. I'll just do it. You won't be able to see it for a second, but 1, 2, fourth one in. 2, 3, fifth one in, education, and they will be there. They're not there at the moment, but they will be there very soon. So the videos will all be there for you if you're current XT. Oh, you can see my chart. It's actually showing the right screen. Hurrah! Sorry, I'm just still getting used to Zoom a little bit. Okay. What's my take on the dollar crashing sometime in the future? I don't know. See, this is my take on that. As I said, it's a double-edged sword sometimes. You know, you look at one of the economies which it's got the most debt and the most everything else, yet it's also at times able to put on the biggest show in the world, isn't it? And you can see the sort of dollar flying. I'm sure that the US don't like the strong dollar they've been sitting with all of this time, and I mean, for sure, I can get into the whole discussion on currencies and how fixed they are in real terms by the nations. I mean, there's Germany absolutely laughing their socks off. I mean, they're starting to squeak a little bit at the moment because the euro's been getting a bit stronger and moan. But realistically, the Germans are absolutely having a well of a time with this funny old currency called the euro, having a great time of it because it's artificially low most of the time. So they do pretty well out of that. The dollar's been probably a little bit higher and so probably quite seriously higher than it should be in some respects. But realistically, is it going to crash? I wouldn't even try and answer that one. Just look at the charts. If it starts breaking down, there's always a chance that something might be the catalyst of it, but I'm not too sure why it'll majorly crash, because at the end of the day, it's a reserve currency, and there's too much tied up into that dollar for it to have too much of a crash. It's not to say it won't pull away quite a way, but yeah, people will. I've been reading for years the doomsayers out there. The market's 2012, wasn't it? Everything was supposed to end. 2000 originally, when the year 2000. It was great IT guys. They did really well out of that for about 2 years or 3 years before 2000. They managed to bump all their rates up so they could make your computer 2000 proof, which at the end of the day turned out to be the biggest scam ever. But all these things, all I'm saying is we just do not know what's going to happen, but I'm sure we'll get some volatility. But my thing all the time is there's no point me guessing what's going to happen. I could give you good reasons why the dollar should go down. I could give you, up until recently, some even bigger reasons why the euro should be on the floor. Yet the euro's been rallying. There are some currencies out there that are much better managed in some respects, and the economies are well matched or whatever else, but those currencies have become quite strong. And I mean, the Swissy I don't even touch. It's a dangerous currency to be trading in my book, because anyone that when they do bad things in terms of manipulation, So I'm not interested in being trading with something that's been being manipulated openly. And then there's currencies like the Aussie dollar, which has been going stronger and stronger, and it's getting to that point where it's a bit uncomfortable for Australia with such a strong dollar. They've got to try somewhere. There's always this sort of battle. No one wants to admit they're concerned about their currency being strong, but they're behind the closed doors. Some of these countries are really fed up with their currencies being too strong, and everyone's moaning theirs is stronger than it should be, and it will always be a bicker. So sorry, I would just trade what's in front of me and try and carry on doing so. How to do your stop loss according to your position size. Yeah, I'll give you an example. Sorry, I'll just do this. I'm just going to use a site that actually XTB might actually have one, but I haven't seen it. Just want a position size calculator. So whatever currency, and let's say this gives you a good idea. So if your currency is in pounds, just pop pounds at the top there. Let's say you've got 5,000 in your account. You're willing to risk up to say 1%. This is a percent of your account. You can switch to money, but I suggest you ignore the money, just work on percentages and just make it a very processed action. You look at your trade and what stop does it need. Let's say it's 30 points, 30 pips. 100,000 is the normal size contracts. So you're looking at a contract size 100,000. Some brokers do 10,000 contracts as a standardized size. 100,000 is norm. Let's just say you're doing it euro dollar. Just calculate this, and it will tell you exactly in every bit that's there. You need to use 0.2 lots effectively. You'll risk around about 50 quid basically. So that's 1% of that account. So it's as simple as that. I think it's very important to do so. And if you've got in a more volatile market, it maybe you actually need to use a sort of slightly bigger stop in there sometimes when you're going to be trading. As you say, I've just increased the top there to 45 pips, for example. You can't be, you've got to be careful that the stop's not too big. Otherwise you end up with this situation where you've got this massive stop because you don't want to be wrong. It's not about being wrong personally, it's just where the stop should be. For me, I don't care I'd rather get stopped out at say 30 pips often, if that's where it should be technically, if that's below the prior lows and giving it a little bit of wiggle room. If I'm putting it there, and if it's I don't want to put an extra 15 pips just to stay in it, or an extra 20 pips just to stay in the trade. But if it's volatile and it's moving around a bit, I do need to make sure it's enough. So just look at that, and you can see the lots 0.14, so 0.14 lots there, and it's as simple as that. Hopefully that's answered your question there. Very simple one. Okay. I'll take that down there. So yeah, it'll be a nice little tool for XTB. It might be on the site. I haven't seen it. I think it's one of the best trading platforms that are out there. Personally, I mean, I've looked at a lot and used a lot, but in terms of platform-wise, it's a really smart platform. If I can find it again, I think I've closed it off now, but. As I say, it's one of the best. Oh, it's on there, isn't it? There it is. Sorry, it's behind there. So it's one of the best platforms that sort of sits out there for simplicity, use of what's on it. I mean, some of the market analysis tools are on there. I love this. It's got the best. I like this heat map. I like the Forex heat map here. It just gives you such a quick view compared to a lot of other brokerages. And again, this heat map's only available if you've got a live account, so you need to have a live account with it, and you can just pick up this heat map, and it's just so useful in terms of identifying those that are largely over this side. The euro, the yen is around about the weakest there of the majors we're looking at. The Canadian dollar's been the strongest. Look, it's right over this side, so see exactly what's going on. Right, answering your question then, should I take more than 1% risk to do swing trading? You might need to. It depends on your position sizing. Some people, they sort of need a big enough position, and the answer can be yes there, but just if you start pushing it too far, I'll turn this on its head a little bit. A lot of traders start out under capitalized. They haven't got enough cash in there to start with, and that's where the problem becomes, because then you are running into having bigger percentages so you can properly trade. Unfortunately, leverage doesn't help us, because margin is just the UK government or the European government's MiFID rules, which don't help brokers. I don't think it doesn't make a lot of difference. Traders, unfortunately, chase off for bigger leverage somewhere else sometimes. The margin requirements are a bit of a pain, but the biggest problem is, as I said, it's that sort of traders don't have big enough pots. And one thing I think they should consider, as a trader, if you haven't got enough money in there, is to gradually put something in there to keep it at the right sort of size, so you're not sort of overdoing it. But as I say, in those circumstances where you've got a smaller accounts, I do realize more modest accounts is all some people can do when they start off there. But the important thing is you're not sitting in this 10 and 20% sort of situation where this. I think it's just like gambling. I say it's all gambling at the end of the day. Can't really claim it's not gambling, but it's gambling with the risk is just too much. It's about being around for the long term. If you lose 1 or 2% on a trade, swing trading, you may need to, as I say, have just a slightly bigger stop, and because of the circumstances, you need to do it. But if you can position size as opposed to increase risk, and you can still get a position in there, actually being a lot likes you can get, you can trade really, really small. So you shouldn't have to break the rules too much. But as I say, maybe 1-2%. That's what you need to do. Hopefully that answers that one. Okay, I really am going to call it quits here. It's 7:10 now on a sunny. It's not at all. It's dark out there. You can see it's gone black behind me. So I am going to call it a day here. I am going to come do some more webinars for XTB. Hopefully in not too distant future. So I'm going to do a specific one, hopefully on day trading. Actually, I've got some ideas and maybe a certain offer for you guys. So there we go. That's it for me.